Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. If you like investing, click subscribe, give me a thumbs up. I'm here to help you guys out. So today I'm going to talk about asymmetric bets. What are they? Why are they important? And why should we position in asymmetric bets? Let's get into this. This is asymmetric bets. I think it's a great thing if you know what asymmetric bets are. So value identification, this is the first thing you need to do. So first you need to identify where the value is. That was our last video. The extreme valuations will tell you that the asset is out of favor and that the money has rotated completely out of that sector. This is where the opportunity is. This means the risk is low to the downside. Now, we don't want to just buy out of favor assets and be stuck in them for many years. So we want to make sure that we see changing market conditions that will induce a rotation of money and reprice assets differently under those changing market conditions. And those things can be shortages, interest rates, inflation. There's a whole bunch of things that can change market conditions for a particular asset. And I'm going to talk a little bit about commodity investing. Value is created two ways: through exploration and developing and producing from a mine. Sectors are governed by market balances. So what I do is I look at cost curves of mining companies and I look at market deficits of that mineral in the future, what the forecasts are. And I'm going to go over a couple of examples of what those look like. This one's an example of uranium. And uranium price was in a bear market from 07, 08 all the way till about today in 2020, 2021. You can see that there was a surplus of uranium. That's what these little red bars are. This is the zero line. This is a deficit under the line, which means that we are short, that the price is going to increase and that we're short uranium in this market. And then we've got surpluses. That's what these positive over zero red bars mean, is that there's a positive surplus of uranium in the market, which means prices are going to decline of uranium. What's projected going forward of 2020 going forward is a large deficit of the uranium sector, which means that we need to mine more uranium for nuclear reactors. And that is going to signal the market. Once these deficits hit the market, prices are going to increase and signal that we need to bring on more supply. So we've got a large deficit out in the future of uranium, which signals that prices will most likely increase and that more new supply is going to have to be brought online. This is a great opportunity for investing in uranium, given the market balances that look like this. Here is palladium market balance, just to show you kind of looking backwards. They were in a surplus palladium. This is a great time to be buying palladium. You want to be buying when there's a surplus and the surplus is declining, just like this. So in 04, 05, 06, 07, 08, this was a great time to be purchasing as these surpluses were being drawn down, and eventually you hit a 0 point, which is also still pretty good. And then when you hit the deficits, eventually inventory runs out and prices really start getting to move to the upside. Palladium in this time frame was a few $100s an ounce. Now over here, it's a mid-2000s an ounce cost. This is the primary uranium global cost curve, just to show you what a cost curve looks like. This is millions of pounds produced on this bottom for the entire world. This is the price in dollars per pound of uranium. This is the cost for certain mines or companies over the production side. So Kazakhstan, with its in situ recovery process, is very low, and they produce quite a bit of uranium from it. And you can see other different areas of mining and how it stacks up and the cost that is to produce. The thing that's very valuable about looking at a cost curve is if you have uranium at $30, you're below some of the mining costs of some of the producers out there. So what you want to do is you want to look at the price of the mineral compare it to the cost curve while also looking at the market balances, the deficits and surpluses. This paints you a picture of that sector and what the forecasted sector is going to look like. And if you can purchase in a surplus area that's declining, like 2018, 2019 of uranium, and you're below the cost curve of some of the mining of the higher cost miners, you're buying in a very low risk area. And what this creates is called an asymmetric bet. And an asymmetric bet is when valuations are extremely favorable, and this is the time you want to place your bet. And what an asymmetric bet is, it's basically limited downside risk with many multiples of upside potential. So you can only lose 100% of your money, but if the sector's already been out of favor for such a long period of time, all of the risk is sucked out of this sector. And what's left is this gaping hole of potential. And what this is known as is an asymmetric bet. And this is what investors are going to look for. They're going to look for limited downside risk with a great multiple of upside potential. And this is where the big money is made in the market, is through asymmetric bets. And what you're going to realize is you're going to be partying alone. You need to show up to the party first and alone before everyone else gets to the party. The valuations and market conditions are what you need to focus on and what you have to rely on, because you're not going to get it from a peer group or other people. This is how you get there first, is off valuations and market conditions. You need to develop an investment strategy to reduce risk and maximize investment potential in asymmetric bets. And I'm going to get to that in later videos on how to do that. The potential returns of asymmetric bets can range from 500% to 100,000%. It depends on how aggressive you got on your entry point and your cost averaging in. You can risk little capital for outsized returns. And this is extremely important here. It is extremely important to have correct position sizes if you are playing with risky companies at bottoms of the market. Keep in mind the cost curve, sometimes the price of the commodity goes below the price of what some companies can produce that mineral for. So at the bottoms of markets, you'll see bankruptcies, share dilutions, and they'll take on excessive debt just to survive. That is when you know you're at a bottom. So you want to position into these asymmetric bets and spread the risk out. I'm going to talk about that in the next video. So what to expect next is I'm going to go over position sizing and how to position for asymmetric bets. The returns can be outsized, but oftentimes the beginning of those investments are riskier, so you need to manage your risk with position size. Asymmetric bets is what makes people wealthy. You have to ignore the retail sector in the herd, so to speak, and you have to focus your efforts on value and market conditions. That value and the upfront work that you do is what's going to provide the base work and the foundation of your return. The better the entry point at the lower valuation, the better your returns will be during the entire revaluation of that asset. So it's important to understand this, to look at the cost curve, to look at the valuations through ratios, to look at the market balances. That is the foundation of a good entry point, is knowing all of those things. Subscribing to this channel, I go over a lot of those things in updates. I go over those things in market conditions on certain videos. So I provide all of that information for you to make well-informed investment decisions in your portfolios. So if you like this content, subscribe to the channel, give me a thumbs up. I appreciate you guys listening. Leave comments, and thank you for listening. This is Finding Value.